Lore, L-O-R-E, is carved in stone someplace. But in reality, no one could find any of the lore when they needed to quote an authority. In the 1960s, the Ford Foundation realized this situation and commissioned Professors William Carey and Craig Bright, Esquire, to examine the legal surroundings of endowment funds. In 1969, they wrote a book titled The Lore, L-A-W, and Lore, L-O-R-E, of endowment funds. What they found was very little L-A-W, but a great deal of L-O-R-E that was generally accepted. The L-O-R-E contained a few simple concepts. The donor gave the institution money or something else of value. This was turned into an investment which did two things. It produced interest and or dividends, and it grew in value. The institution could spend the interest and or dividends, but it could not spend the principal, even as that principal increased in value. Since inflation has always been with us to some degree, the increase in value was looked upon as nature's way of keeping the fund relevant to the institution. The interest and dividends that the inflated investment produced was able to purchase as much as the original income generated from the original gift. So what does this mean? Well, as an example, if I donated $20,000 to my college to purchase business books for the library, that $20,000 will produce perhaps $1,000 of interest or dividends, and 10 books costing $100 each could be purchased. 50 years from now, I would like to see that the college can still purchase 10 books per year. In order to do that, when books are then costing $250 each, the college will have to grow my $20,000 donation to something like $50,000 to produce enough money to buy 10 books at $250 each. Obviously, the college can never spend any of the principal because it is needed to generate income to purchase books in accordance with my directive. The example I just provided is one where the donor specified how the income that the endowment fund generated was to be used. Most endowment funds, however, do not specify how the income is to be used, thereby allowing the institution to use the income in any manner that is consistent with the tax-exempt mission of the institution. Now, some people would call the former a restricted endowment and call the latter an unrestricted endowment. I do not care for those terms. It is more accurate to call the former an endowment where the income is restricted to a specific purpose, and refer to the latter as an endowment where the income is unrestricted. Unfortunately, endowments and endowment accounting is a complex subject, and being very precise in our language helps avoid confusion and misunderstanding. According to the law, L-O-R-E, the principle of an endowment was restricted in perpetuity. Thus, the term unrestricted endowment would appear to be a contradiction in terms, and this is one of the reasons why I don't like it. I'd rather say an endowment where the income is unrestricted. Now let's pause for a minute to think about this concept that the institution can never spend the principal of an endowment fund. According to the LORE, the donor gave the gift principal to the institution because he or she wanted to endow the institution's activities. The donor wanted to provide an annual source of income to be used for either general operating purposes or for a specific purpose. According to the LORE, in many respects, the donor was making a gift to the mission of the institution and not really to the institution itself. Especially in the case of an endowment gift whose income was restricted to a specific purpose, the institution was not free to change the purposes to which the income was directed, regardless of how many hundreds of years had passed since the gift was received. If the institution could no longer spend the money for the specific purpose because they no longer addressed that issue or otherwise did not need the funds, the institution was to seek another institution that could comply with the donor's wishes. And an institution could not go out of business without passing the endowment along to another institution. This concept that the endowment belongs to the mission or purpose rather than to the institution itself is very important. Recently, there have been lawsuits brought by donors, their families, and state attorney generals against institutions and their officers for misuse of endowment funds. If you want, you could Google Robinson family versus Princeton University and read a very complex and long-lasting case where the children of the original donors, Mr. and Mrs. Robinson, gave substantial sums to Princeton University, and the children challenged whether the university was complying with their parents' wishes. I won't tell you who won. You can read that for yourself. The nature of investments change over time. As late as the middle of the 20th century, almost all investments paid interest or dividends to their owners. The last half of the 20th century saw a great deal of changes in investments, a number of new ways to make money. Soon there were companies selling their stock and not paying any dividends. Perhaps the most famous of these companies is Apple Computer. As you may know, they're going to pay their first dividend ever in 2012, even though the company was formed in the late 70s. Thus far, Apple has never paid a dividend, even though it is a very highly valued company with millions of dollars of cash on its balance sheet. Investors keep purchasing Apple shares. Why? Because they expect those shares to be worth more tomorrow than they are worth today when they buy them. Why, they say, be satisfied with a $4 per share dividend if the value of the stock increases by $10? Obviously, this situation became a problem for endowment fund managers. They wanted the $4 dividend because under law, L-O-R-E, they could spend dividends on current operations. But they were giving up the $10 increase in value by investing in the stock that is paying a dividend instead of investing in something like Apple. Now, it's a basic principle of investing that one should invest to maximize their return. You should not invest reduced interest in dividends to the exclusion of capital gains. So something needed to be done to remedy this dilemma in the endowment business. The states got together and decided it was time to move from law, L-O-R-E, to law, L-A-W. An organization known as the Uniform Law Commission, also known as the National Conference of Commissioners on Uniform State Laws, which was established back in 1892 and provides states with nonpartisan, well-conceived and well-drafted legislation that aims to bring clarity and stability to critical areas of state statutory law, established a commission to study institutional funds, that is, funds held by an institution exclusively for charitable purposes. In 1972, the commission approved the Uniform Management of Institutional Funds Act, or what is known as UMIFA. This was approved by most states in 1973 or shortly thereafter. In reality, the states do not improve the UMIFA law. They actually write their own law, which usually closely follows the Uniform Act's language. However, there frequently are differences between the states, and the Rhode Island UMIFA law contained a provision that no other state included in their law. We'll talk about that a little later. So what did the UMIFA law do? Of course, the first thing it did is replace a great deal of L-O-R-E with L-A-W. It did not merely codify the old L-O-R-E, it changed a great deal of that L-O-R-E. UMIFA did some things that wrote into law many of the actions that were already being taken by most nonprofit boards. For example, the law provided that funds could be invested, and they provided for the fact that a nonprofit organization could hire an investment manager. Prior to this law, UMIFA law, there were people wondering whether a nonprofit organization could actually hire a professional investment manager who obviously wants to be paid and use investment funds for paying the investment manager. So the UMIFA law indicated that that was Okay. The UMIFA law also provided some guidance on the board's fiduciary responsibility. It spoke about the prudent use of appreciation, something called the standard of business care in exercising the board's duties. The major change, however, promulgated by the UMIFA law was a change in the manner of releasing funds for spending. Here we see a typical year's activity in an endowment fund. The investments at the beginning of the period were $10,000. Interest and dividends received during the period of $4,000. There was $600 of realized capital gains, $900 of unrealized capital gains. This is where the stock that had been held onto increased in value. And the organization withdrew $4,000 because for spending in current operations. Now, endowment law would say that the interest and dividends constituted the interest and dividends constituted the amount of income that could be spent for operations. But what is income? Is it just this $4,000, or is it the $5,500 represented by the $4,000 of interest and dividends, plus the $600 of capital gains, plus the $900 of unrealized capital gains? Now, before we go to the next slide, I want you to remember that this situation resulted in an investment balance at the end of the year of $11,500. Now here is a different situation. It starts with the same $10,000 at the beginning of the year. Interest and dividends, however, are only $400, but realized capital gains are $6,000. Unrealized capital gains are $900, and withdrawals were the same $4,000 we saw in the previous slide. This investment balance at the end of the year, however, is $13,300, much greater than the $11,500 we saw earlier. So again, the question is, what is the income? Is it the $400 of interest and dividends, or is it the entire $7,300 of interest, dividends, capital gains, and unrealized capital gains? If we were still in the situation of the old LORE, this organization would only be able to withdraw $400 for operations because that was the amount of interest and dividends. Yet this endowment manager, who has an endowment balance at the end of the year of $13,300, even after withdrawing $4,000, has done better than this endowment manager, who, although achieving $4,000 of interest and dividends, ended up with $11,500. So you can see the problem that UMIFA tried to solve, and this is how they solved it. UMIFA requires an organization to develop a spending policy. Basically, a spending policy is a formula that calculates the annual appropriation from the endowment fund. The spending policy takes the place of the old LORE that indicated you can only spend interest and dividends and you must save the rest. So let's look at this spending policy. It says the board has adopted an endowment spending policy that calls for appropriating 5% of the average market value of the endowment measured over the previous 12 quarters ending June 30th prior to the beginning of the next calendar year. So this is an organization with a January to December 31st year end. Its spending policy is to calculate 5% of the average market value for the 12 quarters ending June 30th. Let's take a look at what this would look like. Here we have the endowment at June 30th, 2011. The balance of the endowment fund is $1,512,548. The 12-quarter average, however, all of this period here, is $1,562,047. 5% of that yields a number of $78,102. This organization with this spending policy as early as sometime in July, as soon as it receives the June 30th balance from the investment company, can calculate how much spending it can make during 2012, 6 months before year end, 6 months before the year is supposed to begin. So this is a very timely calculation for budgetary purposes. This organization knows that it can withdraw $78,102 from the endowment fund beginning January 1st, 2012. So now we have seen how UMIFA changed spending. This change is frequently referred to as viewing an endowment on the basis of its total return and appropriating a portion of the total return for annual spending. But what about the growth of the endowment that was inherent in the old LORE? Endowment growth is a basic cornerstone of a properly managed endowment. As I said earlier, if my donation to my university could purchase 10 books in 1990, the endowment should be managed so that they can purchase 10 books in 2040, 50 years from then. Some conservative endowment proponents actually say that the endowment fund should be managed to be able to purchase more books in 2040 if the size of the university has grown. So for example, if a library purchased 10 books when the student body numbered 2,000, it has to purchase more books when the student body doubles to 4,000 students, while the relevance of my donation has declined. Now, this is just a hint of the complexities of endowments. In 2006, the National Conference of Commissioners of Uniform State Laws again got together and indicated that the UMIFA law had been around for over 35 years and perhaps it needed to change. In 2006, the National Conference of Commissioners of Uniform State Laws adopted something called the Uniform Prudent Management of Institutional Funds Act, and this is now known as UPMIFA. So UMIFA has gone away, and UPMIFA is now the law in most states. As you can see from the title of UPMIFA, the Uniform Prudent Management of Institutional Funds Act, the emphasis is on the word prudence. And prudent norms evolve over time. Boards and endowment managers are to act within this evolving standard of prudence and not be bound by hard and fast rules. This is a move to bring judgment back into the endowment management practices of the institution. Now, what are some of the changes between UMIFA and UPMIFA? Historic dollar value was essentially the initial value of an endowment gift. If for some reason the value of an endowment gift slipped below its historic dollar value, appropriations from the fund were to be suspended. UPMIFA eliminated the concept of historic dollar value. So there is no longer an automatic stopping point at which time you must stop withdrawing from an endowment fund for operations. Instead, UPMIFA provides guidance in the form of a list of factors to be considered when making investment and spending decisions. One of these factors, however, is closely directed toward the preservation of the endowment fund. This is referred to in one place in the UPMIFA law as assuring generational equity. The prior UMIFA law created rules that were designed to assure that the endowment fund was preserved for generations, but it never stated this generational equity concept or goal as clearly as the UMIFA law does. So if endowment growth is a basic cornerstone of a properly managed endowment, UPMIFA adds the mortar cementing this cornerstone into place. Here are the 7 factors that a board is to consider when managing a charity's endowment fund. The duration of the fund is the initial factor to consider. While we have spoken thus far today about funds that are perpetual, it is possible that a donor provides a fund to function as an endowment fund, but to do so for only a limited amount of time. say 20 or 50 years. Thus, it is important for the institution to understand whether they have a permanently restricted fund or one that is restricted for only a specific number of years. Once you know the duration of the fund, this fact also requires you to manage the fund in such a way that it will last for the intended amount of time. The fund must be preserved for its entire life, either perpetual or for a specified amount of time that is shorter than permanently. The next factor to consider is the purpose of the fund and the purpose of the institution. Funds are either for the general support of the institution or some specific aspect of the institution's mission. In managing the endowment fund, the board must be sure to manage it so as to best achieve the institutional mission and purpose of the fund. Endowment fund management decisions are obviously impacted by general economic conditions. There is no one rule book on how to invest or how to withdraw funds. Such decisions are variable with the economic conditions of the time. Therefore, it is obvious that boards must reevaluate their investment and spending policy continually over time and make adjustments as dictated by the general economic conditions at that time. Boards must recognize the impact of inflation or deflation when instituting endowment investment and spending policies. The board cannot say after investing in a 50-year fixed income security, ooh, this would have been a good investment decision if it weren't for the effect of inflation. The law requires them to consider the effect of inflation. Total return means that a fund produces many kinds of returns: interest, dividends, and capital gains net of capital losses. This decision factor means that a board must not consider only interest and dividends or only capital gains. It must factor into its endowment management decisions the total return of the funds. Under the old law, LORE, income was defined as interest and dividends. Now, spendable income is defined as a percentage of the total return produced by the endowment fund. The funds must be managed to maximize its total return with no priority placed on either interest, dividends, or capital gains. The board must also realize that the endowment funds are not the sole resources available to the institution. Institutions should have other financial resources available to them to run their operations, and the board must take these into consideration when making endowment management decisions. And lastly, if an organization has an investment policy that exists outside of the endowment fund policies, that investment policy should be adhered to within the endowment management policies. For example, if a hospital has a policy prohibiting tobacco-related investments, that policy should also impact the endowment investment policy, presumably prohibiting tobacco-related investments within the endowment fund. So remember, these factors are generally included in every state's UPMIFA law. Therefore, these factors are not suggestions, but they carry the weight of law, LAW. We are no longer in a situation of LORE. This is one of the difficulties I find as I teach CPAs and boards about the new UPMIFA law. People are so accustomed to the old situation where there was only LORE and no one enforcing it that they do not look at the UPMIFA law as a document carrying the full force of the law. The key changes, to summarize, that came along with UPMIFA, the changes from the 1970s UMIFA law, are generally these three. The historic dollar value of the endowment fund was defined as the original donation from the donor. This was true in all states except Rhode Island, where the law stated that historic dollar value had to change from time to time to reflect the rate of inflation. So in Rhode Island, historic dollar value generally increased each year, even though the phrase in the law from time to time did not necessarily mandate an annual adjustment. UMIFA laws generally said that if the value of a fund dipped below the historic dollar value, spending from the fund should stop until the fund recovered. This was a benign part of the law until the stock market decline in 2001 and the even larger stock market decline in 2008 and 2009. The other provisions of the UMIFA laws was some mechanism that limited the amount of spending. In many states, the law said that a spending policy of 7% or more carried with it a rebuttable presumption that the spending level was imprudent. Rhode Island did not have such a provision since it already mandated that the historic dollar value increased by the rate of inflation, and therefore it could spend everything else. But in the states where there was the 7% rule, if they followed a policy where the spending policy was set below 7%, the fund would probably achieve an automatic increase because a balanced fund was generally producing an 8 to 10% total return. So if you limited, the law in the state limited a spending policy to 7% or lower, and the fund was achieving 8 to 10% total returns, the fund was already growing. In Rhode Island, you didn't have a limit on the 7% spending policy, but you had a mandatory increase to the historic dollar value. But these mechanisms all disappeared with UPMIFA. The UPMIFA law demands prudent investing and prudent spending guided by the decision factors. Many people believe that the UPMIFA law is a liberalization of the UMIFA law, but legal scholars have concluded exactly the opposite. Legal scholars point out that the fact that the endowment fund must be managed to account for the effects of inflation now more clearly establishes what was always in the Rhode Island law. Endowment funds must keep pace with inflation. So to demonstrate what this means, let's look at another example. Earlier I used almost the same example, and here it is again with a little more detail. So we have Jack Smith giving his university $50,000 as an endowment, the income for which is to be used to buy business books for the library. The university has a 4% endowment spending policy. In 2013, the university appropriated $2,000 from the endowment fund. That's 4% of the $50,000 gift. It was able to buy 20 books in library quality bindings for the business library. The $50,000 fund realized a total return of $4,300 during 2013. The way that ABC University keeps track of this endowment fund is with a basic spreadsheet. So we see that we have the Jack Smith Fund. Its purpose is business books. Its balance on January 1st, 2012 was $50,000. I should say December 31st, 2012. The spending that was available during 2013, 4% of the $50,000 or $2,000. The total earnings in 2013, $4,300. Total return, interest, dividends, realized and unrealized capital gain, such that the balance in the investment account at the end of 2013 is $52,300. This spreadsheet is the way most organizations, I would say 75% of the institutions, keep track of their endowment funds. There's plenty of room here to add more donors, and there's plenty of room here to continue going out for years. So this column here would be the spending policy for 2014, the earnings for 2014, the balance at the end of 2014. We have seen in this example that Jack Smith's original gift allowed his alma mater to purchase 20 books for the library in library quality bindings. Mr. Smith understood that this is what his gift would provide because he is a sophisticated donor, something we must assume of all donors. If he had only wanted the university to purchase 10 books, half as many as the 20 they're able to purchase, his gift would only have been $25,000, half as much. Mr. Smith made his endowment gift permanently restricted. He wants the university to replenish the business books with new writings each year so that the library stays current. And he wants this to continue indefinitely or in perpetuity. The university has agreed to this when they accepted his gift with his restriction. A permanent gift with income restricted to purchasing 20 business books for the library each year. Actually, Mr. Smith didn't have to say 20 books. He knew, presumably, the university spending policy of 4%, so he knew that his $50,000 would produce $2,000, and however many books that purchased was fine with him. The point is that in the next year, the university should be able to purchase the same number of books. Now, this type of endowment gift and acceptance by the university has been interpreted by many courts as a contract between Mr. Smith and the university. The UPMIFA law says that the university must manage Mr. Smith's endowment so that it is able to perform under the terms of this contract. Now that we have covered the basics of endowments, let's turn our discussion to some of the things you want to have in place when you are committed to developing an endowment fund. The reality of the endowment donor is that they are making an investment in an organization, and nothing encourages investing like results. In order to have good results in your endowment program, you need policies, procedures, and clear communications. The gift acceptance policies that reside for the most part in the development office are very critical. You probably thought I was going to talk about spending and investment policies as being critical to the success of the endowment fund. And yes, those are important to the ongoing management of the fund. But getting the donations in the door is the all-important first step. Will you accept cash, securities? What about cars, boats, and houses? This sort of thing should be discussed before a donor appears on your doorstep. In that way, you can respond to a donor with an appropriate response without having to convene a committee meeting and potentially lose the donor's interest. While you cannot anticipate every possible restriction that a donor might want to place on their gift, you can develop some suggested restricted purposes for endowment gifts and use this as a marketing tool. As a general rule in fundraising, the more specific your request, the more successful the fundraising program. Named funds are also a great fundraising tool. Not only do they inspire the donor and their family, but they also inspire a wide circle of people who know the donor. The spending policy is not just a policy for the accounting department. The development office also needs to understand how endowments work, and they need to understand this as well as the fiscal office does. If the development office does not have this understanding, an organization may end up accepting restricted gifts with which it cannot easily comply. As an example, I have seen organizations that have accepted endowment donations with income restricted to specific programs, yet the amount of the donation is so high that under the organization's spending policy, the donation would produce more income than the organization is currently spending on the targeted program. One college I read about had $1 million endowment where the income was restricted to purchasing uniforms for the school's basketball team. Under the school spending policy, the $1 million endowment produced approximately $50,000 of spendable income each year. And you can imagine it is very difficult to spend $50,000 on uniforms for 15 young men in shorts and T-shirts. So you can see why a good understanding of the spending policy is essential for the development office. The investment policy. The investment policy has to fit economic conditions and the spending policy. If inflation is running at 2% per year and the spending policy is 5% per year, then the investment policy has to be one that is aimed at producing approximately a 7% or more total return. Now, some people ask me which policy should be crafted first, the spending or the investment policy. Rather than try to answer this question, I prefer to emphasize the concept that they both must fit together. After the policies are crafted to fit together, actual investment results need to be monitored. If total return is not producing sufficient returns to cover spending and inflation, one of two things should be contemplated: a change in investment tactics, with the goal of increasing total return, or a decrease in the spending policy rate so that the endowment fund maintains its generational equity. With the flexibility built into the UPMIFA law, these changes do not need to be made on an annual basis. There is no fixed rule as to when a change in policy should be implemented. Prudence dictates every single action. The last part of a good endowment program is the communication with donors. And by donors, I mean all donors, past donors, present donors, and future donors. In most institutions, the endowment is the financial foundation on which the organization builds its programs. No fundraising plea is easier to make than the case for a solid foundation. Organizations should produce an annual document that discusses the status of the endowment fund, disclosing the amount of financial support provided by the fund, as well as the health of the fund, meaning the current balance, is information that will encourage endowment interest and participation by all donors. At KLR, we have some very specific products and ideas relating to the endowment communication process, which we'll be happy to discuss with you. Unfortunately, the physical constraints of time prevent us from getting into this in more detail today. Feel free to contact me anytime for additional information on this endowment communication process. Now we will turn our attention to accounting for endowment activity. This is a complicated subject. We will demonstrate endowment accounting and reporting by using this example that we used earlier. So once again, this is the $50,000 endowment gift. The school has a 4% spending policy, and during the first year, it produced $4,300 of total return. The initial gift, which may have been in cash, but regardless was ultimately invested in the investments according to the university's investment policy, is recorded as a permanently restricted gift and will reside in permanently restricted net assets. So the journal entry to record the gift is this debit to investments and a credit to permanently restricted gifts. The accounting literature indicates that this $50,000 of permanently restricted net asset balance must remain as permanently restricted balance even if the market value of the investment drops below $50,000 for any reason. Now, hopefully this does not happen too frequently. But when there is a decline in market values and the investment balance falls below the original endowment gift, this is known as an endowment being below water. And this does create a unique accounting situation. So I'd like to go on a little tangent for a moment to examine this situation. Although there is no requirement to practice fund accounting in a not-for-profit organization, the concepts of fund accounting are very useful for understanding an endowment fund. If you recall, very early in the webinar, I mentioned that the endowment belongs more to the organization's mission than it does to the legal entity that is the organization. So here I have created a fund accounting type of balance sheet where we have an operating and an endowment fund. And I put down here the basic accounting equation to remind you that assets equal liabilities plus equity. And in fund accounting, assets must equal liabilities plus equity in both the funds, or in all funds, in this case the endowment fund and the operating fund. Now here is the balance sheet for Jack Smith's donation. I've included some numbers in the operating column, but they are meaningless right now. And I've included the $50,000 investments and the $50,000 permanently restricted net asset. The only number I want you to pay attention to or remember in the operating column is this $560,000 of unrestricted, temporarily unrestricted net assets. What would happen if the investment balance dipped below $50,000? In this case, it became $45,000. Thus, the Jack Smith endowment is underwater by $5,000. As I indicated, however, the permanently restricted net assets are not allowed to dip below their $50,000 balance. So the permanently restricted net asset balance here must stay at $50,000. Therefore, in order for this balance sheet to balance in every column, the operating fund needs to either send $5,000 in cash to the endowment fund or at least promise to send it to them by recording a payable. So here we have the $5,000 payable from the operating fund, which becomes an asset in the endowment fund. And now we have $50,000 of assets equaling the $50,000 of equity in the endowment fund. Endowment funds never have liabilities. Notice that what happened is the net unrestricted net assets of the operating fund changed from the $560,000 I pointed out previously to $555,000. So I think this truly emphasizes that the endowment fund is an entity almost in and of itself. $50,000 is required to be maintained as permanently restricted, and the fact that the investments in which the $50,000 was invested have fallen below $50,000 does not change this figure. Okay, now moving back to our demonstration. We have seen the initial accounting for the donation, and we went on a tangent to demonstrate the permanent part of permanently restricted donations and the resulting permanently restricted net assets. As we noted earlier, the university had a spending policy that allows them to allocate 4% of the investment balance as of the end of the year. For this purpose, we're not using a 12-quarter average, just for this example. So since the balance of Jack Smith's fund was $50,000, 4% of that was $2,000. This $2,000 is the amount the university has available to spend on Smith's restricted purpose, buying business books for the library. On January 1st of 2013, the university may withdraw $2,000 from the endowment investment account and deposit it into an operating cash account. The credit side of this entry, since this is an endowment fund with a restricted purpose, the credit side of this entry is to temporarily restricted income. If the university does not make the withdrawal on January 1st, 2013, it could record a debit to a receivable from the endowment fund if it were practicing fund accounting. The fact that this is temporarily restricted investment income means that this income will be accounted for within the operations of the university, just like any other temporarily restricted donation. It will be released from restriction as the university incurs expenditures that satisfy the restriction. If the cash was withdrawn and this operating entry was made on January 1st, 2013, a corresponding entry will be required in the endowment fund. That's the difficulty of fund accounting, is that every transaction requires an entry in each fund. The entry in the endowment fund is a debit to investment income and a credit to investments. Now, the credit to investments is easily understood because $2,000 is sent over to the operating account. The debit to investment income is a little more difficult to understand, but that'll become more evident as we work through this example. First, let's take a look at how this will look on the statement of operations. So here is the statement of operations, and I've also included in the statement of operations both an operating and an endowment column. And you see we have revenues and expenses in the unrestricted net asset section, revenues and expenses in the temporarily restricted net asset section, and revenues in the permanently restricted class of assets. Here is the $2,000 of investment income that was being received by the operating fund from the endowment fund, and it becomes a change in temporarily restricted net asset. Here's the negative $2,000 in investment income of the endowment fund and a negative change in temporarily restricted net assets. Now, the fact that I'm talking about temporarily restricted net assets in the endowment fund is yet another area that could potentially confuse people. Yes, there are temporarily restricted assets in the operating fund and in the endowment fund. And although they are both called temporarily restricted, they are not the same, and they do not function in exactly the same manner. We'll see this as we work through this example. So let's go back to the facts of our example for a minute. And now we will focus on the fact that the fund produced the $4,300 of total return during 2013. This is recorded in the endowment column as a debit to investments of $4,300 and a credit to investment income, $4,300. Now, if you remember, the previous entry was a debit to investment income of $2,000 in the endowment fund. And also, if you remember, the balance of the endowment at the end of this was $52,300. So this is the activity in the Jack Smith investment. He had a balance of $50,000, or he gave us $50,000 at the beginning of the year. Excuse me. They withdrew $2,000 because that was the spending policy. They earned $4,300, so the balance at the end of the year was $52,300. The endowment fund net investment income is $2,300. Sum of these two numbers right here. This is the change in temporarily restricted net assets of the endowment fund. Now, since only the spending policy amount was available for supporting operations, many people prefer to display a statement of operations that separates results from operations separately from non-operating items. The endowment income that did not go to operations qualifies as an item that may be reported as a component of non-operating income. Now remember, I said this income is reported as part of the change in temporarily restricted net assets, even though it was earned by the permanently restricted net assets in the endowment fund. As I said, this could be confusing, but let's go back to the statement of operations and see how this looks. We previously saw the $2,000 of investment income come into the operating account and result in a positive change in temporarily restricted net assets. Now, after realizing the total return of $4,300, what was here as a negative $2,000 is now a positive $2,300. And for the total organization, $4,300 of investment earnings is actually right there. Within the endowment account, we have a positive change in temporarily restricted net assets within the endowment of $2,300. So the endowment account now has permanently restricted net assets of $50,000 and temporarily restricted net assets of $2,300. This was the endowment balance sheet at the beginning of the year when the investment went up to $52,300. You can see this account doesn't balance yet. But when we bring in the temporarily restricted net assets in the endowment net assets, now we have an account that balances $52,300 in equity, $52,300 in assets. If you don't have the underwater problem, this is how your endowment fund should look year after year. The $50,000 will remain the same because that's permanently restricted, and you should see an ever-increasing amount of temporarily restricted money because you are not spending as much as you are earning. Your spending policy is lower than your total return produced by your investment policy. The fact that this fund is increasing to $52,300, and now the school can take 4% of $52,300, is how the school gets to assure generational equity in this endowment. Now I'd like to take another little tangent just to demonstrate one of the easy errors that I see organizations make when trying to account for endowment funds. So this is the balance sheet from our example. I have modified the asset section slightly. As you recall in our example, when we calculated the spending policy amount of $2,000, I said it could be withdrawn as early as January 1st, 2013. As you can imagine, that seldom happens. As a matter of fact, people tend to leave money in the investment account for as long as possible. And they do this for good reason. This is the place where they are getting the best return for their money. So frequently, at the end of the year, they still have not withdrawn the $2,000 of appropriated money out of the investment account. Notice that I am not saying it was not withdrawn out of the endowment account. I said it was not withdrawn out of the investment account. A key part of avoiding problems in endowment accounting is to realize that the endowment fund and the investment account are not one and the same. So if this organization still had $54,300 in the investment account at 12/31/13, what would the balance sheet look like? The balance sheet would look like investments of $54,300, but still only $52,300 is in the endowment column. The other $2,000 is in the operating column. That is the appropriation. It just hadn't been withdrawn. So instead of it being in cash, it's in investments. And here we have an investment account with commingled money. Some belongs to the endowment fund, some belongs to the operating fund. Now you can see that the investment account and the endowment fund are not one and the same. When you perform the spending policy calculation for 2014, it will be 4% of the $52,300, not 4% of the $54,300 that is in the investment account. Okay, we're going to continue with our example for one more year in order to demonstrate endowment accounting during a time when the investment market is not experiencing good returns. At the beginning of the next year, this organization can again make their appropriation based on their spending policy. Because the balance of the endowment fund has increased, the amount appropriated also increases. And if there has been any inflation since the prior year, then this $2,092 will have the same purchasing power as the $2,000 did a year ago. As we proceed through 2014, however, suppose that instead of a healthy return on investments, they actually decline in value so that the overall return is a negative $1,500. Thus, our endowment will look like this. We started with $52,300. We withdrew $2,092, and then our total return was a negative $1,500, so that the investment balance at the end of 2014 was $48,708. The income statement would look like this. We'd have investment income in the operating column of $2,092, but we'd have investment income, we have negative investment income or investment loss in the endowment column of negative $3,592. Now some people get a bit confused because they don't understand how the $2,092 of income is being reported in a year that had net investment losses. However, this is no different than endowment accounting was in the days before UMIFA. Interest and dividends would have been reported as income, and the overall decline in the endowment investments would have been reported as net investment loss in the endowment account. Now, how is this terrible investment year going to be reflected on the balance sheet? Well, let's look. We have only $48,708 in investments. We have to keep a $50,000 permanently restricted net asset balance. So we have a negative temporarily restricted balance, and draw my line very well, of negative $1,292. If we want this to be a zero balance, we'll have to record another asset. We'll have to either receive an asset or record an asset from the operating account. So this is probably more accurately reported as follows. Still have the $48,708 investment here. Now we have the interfund payable. The reality is we have zero temporarily restricted assets, and we still have a $50,000 permanently restricted net asset balance. I can't overemphasize, this will never change. This fund is now below the balance it was 2 years ago, yet inflation may have been 2.5% each year. So what does this mean vis-a-vis the law to maintain generational equity? Well, if our original gift was $50,000 in 2012 and we had 2.5% inflation in 2013 and 2.5% inflation in 2014, this would be 2.5% of the $51,250 balance, we should have $52,531 at the end of 2014. But in reality, we only have $48,708. What this means is that the board has to take a look at their 4% spending policy, at their investment policy, which is not producing great returns, and make some sort of adjustments. You don't want to keep paying out a 4% spending policy, but any amount digs the hole a little deeper. If you are confident in the economy and the long-term investment performance, I think you probably reduce the spending policy and reevaluate again next year. Well, it's 3 p.m. and we'll stop here. You probably all have an endowment accounting headache by now. If I did not get to your question, I will try to answer it via email, or you can also send me questions later on and I'll try to answer them. If you are interested in CPE for attending today, please email me and I will get that in motion. Now, to help us evaluate our efforts in this and other webinars, I would appreciate your feedback. We will be sending you a follow-up email in which we will have a link to the KLR website where you will be able to obtain a copy of the slides and a recording of the webinar, as well as a KLR white paper on endowment disclosures. Send me your questions. Perhaps they will lead to a second webinar on endowment accounting. We are also thinking of repeating this webinar as a live seminar in both Providence and Waltham. So please let us know what you think of that idea, and keep an eye on the KLR website for more details. We'll also be conducting another webinar in September, so send me the subjects which you would like to see addressed. As always, I'll try to answer the questions you think of beyond today if you call or email me. And as in the past, I have, if you haven't seen my Mission That Is blog, in the past couple of weeks I've written 2 blogs on endowment issues. You can find these on the KLR website looking for the Mission That Is blog. Thank you very much for participating in today's webinar and in our board development series. We will keep you informed of future presentations. Please visit the KLR website to get to know us better so that we can better serve you. Have a wonderful day. And